Today we answer the question, I've been maxing out my 401k, what do I do next? Here are 5 things you might want to consider. So today's going to be a little different. I'm going to be speaking to a specific group of individuals. So feel free to share it with any friends that you have that might be falling into this group that you think might need a little investment management help. But what we're talking about today and what we're targeting is 5 things that you might want to implement if you are an individual who's using your 401k but might not be sure what's next. Or maybe you're a business owner that's using the 401k and you've not really worked with somebody. You're a high earner that's using the 401k and not sure what you do after that or if that's really going to be enough. Because a lot of the times, if you're a high earner, just the 401k is not going to get you to retirement. So we're going to talk about 5 strategies that you may want to consider as one of those individuals. I want to be clear that working with a financial advisor is not just for the rich or the wealthy or a business owner or a high earner. Here at 10 Capital, we never did set minimums, and the reason for that is because we want to be able to service people who need our services at the end of the day, right? And it might make sense that we work with a young individual who has tax issues, who needs a little bit of help with their business and getting it on track in terms of what they're going to be saving, how they're going to be saving, or a person that's transitioning into retirement. They've saved for years and years and years, and they didn't really ever have a plan. They might have just worked with an old broker to manage their investment assets, and now they need to get serious about how they're going to be taking distributions off their portfolio for the next 30 years of their retirement. But to be clear, we work with both of those groups. And some people in town will work with people who are just starting off as well, but we're not targeting the group who is just starting saving today. We're targeting these 2 groups. Either you're already investing into the 401ks and you want to know what's next, or you're transitioning into retirement and you're wondering, how am I going to take an income stream off of this, right? Some of these 5 points are going to hit, some of them are not. And I'm really leaning more towards the group who's focused on saving into the 401k still and has a few years yet pre-retirement before they take distribution. So first one, right? I already said it, we're maxing the 401k. This year, if you're under age 50, you can do $23,000 in deferral into a 401k. Right? Which is awesome. If you're over age 50, you can do a $7,500 catch up into the 401k. So you got $30,500 out of your own earnings that goes into there, right? And there's no issues in terms of your income, whether that could be pre-tax or post-tax, traditional or Roth, because there is no Roth phase out on a 401k like there is an IRA. Now, if you are a business owner and you have sponsored a 401k plan, you might want to consider putting your spouse on the payroll. That could help with having one additional person in the 401k plan. It allows you to do the $30,000 if you're over age 50, and it could allow your spouse to also do the $30,000 if you're over age 50. You could pull that from your earnings, put them on the payroll, give that to them as earnings, save yourself $60,000 in taxable income if you're doing it on a pre-tax basis, right? So good tax saving strategy, right? You're both getting to max the 401k. That's point 1 and 2, max the 401k. Put your spouse on the payroll if you have the ability to do so, and they are not already participating in a 401k plan with a match. The third point that I want to make sure that we hit on here is called the Backdoor Roth IRA. So this is an awesome strategy for those that don't already have a pre-tax IRA in place. If you do, there is also strategies to still accomplish the same goal. The quick and dirty version of it is what you're doing is you're making a non-tax deductible contribution to your zero balance IRA, right? Can't deduct that because you make too much money into the IRA. Then you do a subsequent conversion to your Roth IRA. That allows you to make the contribution to the Roth IRA, but not directly, right? So non-tax deductible contribution, conversion, same time period. So that way you've gotten it in there and it's going to grow tax-free until you are of the age at which you're going to need to take it, which is awesome. Fourth thing that we want to make sure that we hit on is always have liquidity, especially as a business owner and as anybody that's a high earner with a family. We all have overhead, we all have expenses. Matt behind the camera and I were just talking about this before. How much should you have in savings? And we always say 3 to 6 months of expenses of overhead is realistic, in my personal belief at least. And I apply that to both your household and your business, right? So it's good to have 3 months of overhead, 3 to 6 months of overhead for the business, 3 to 6 months of overhead and personal expenses at home. What's common that we see for a lot of business owners is they keep 3 to 6 months of expenses in the business. And this will depend on your organizational structure, whether you're an LLC, a C Corp, or an S Corp. But if you're a flow-through entity, that money's already taxed anyways. So 3 to 6 months in the business, take the rest of it home, and then invest it into a brokerage account. Very common. We can even do lines of credits on the brokerage account so that if you had a cash flow issue with your business, you could tap that line of credit, have it go back into your business as a note, as a loan from you personally to the business, right? That's a debt on your balance sheet for the business. Lots of fun strategies. We can dig into these more. I don't want to dig into them too much because I want you to actually pay attention a little bit. The last thing, it's boring, but it's necessary. It's life insurance. So I know life insurance is one of the least fun things to talk about, right? Because it does mean you're dead. But it's important for family, it's important for business, right? So as a business owner, as a high net worth individual, someone who's a high earner, even someone who's not a high earner, right? I tell people you really need life insurance. General rule of thumb is 7 to 10 times your annual income in death benefit, right? And I know there's a debate back and forth whether you get term life or whole life, and really at the end of the day, it's just get some, right? Be covered. But term life is going to be the most affordable version. And my personal belief is that when you're in retirement and you're financially independent, that you probably shouldn't need life insurance for the sake of protection. There might be a case in which whole life insurance makes sense because you have a liquidity issue, because your estate is taxable, or you want to use it as a retirement planning strategy where you take tax-free distributions against the death benefit. Technically, it's loans against the death benefit. Just to wrap it all up, that's what 5 things that you want to consider, right? We're maxing our 401k. Maybe we're putting our spouse on the payroll if they're not covered. We're considering the Backdoor Roth IRA if it makes sense. We want to make sure we always have liquidity to cover anything that might come up that we're not aware of or that's unexpected, and then invest the rest. And then it's boring, but it's necessary, life insurance. So I hope you guys enjoyed this today. Hopefully you've learned something new. If you have any questions, feel free to reach us. If you have any questions, feel free to reach out to us here at 10 Capital, and we'll do our best to answer them. Have a great weekend.